So today we will be dealing with a general introduction into accounting. So I will be covering the definition of accounting, the purpose of accounting, and also the accounting process. And I will give you guys the scenario that will enable you to easily understand the accounting equation. So let's start with the definition of accounting. So everybody out there surely wants to know, what is this accounting? What is it? Why is it so important? And why are so many people or many businesses required to understand this information or understand about accounting? So generally, accounting accounting is an information system that is used to analyze, to measure, to interpret, and also to present the financial health of the business. So it enables owners to understand how much the business is worth, and to understand how the business is performing, and also to understand how much money is coming in and out, which is also referred to as the cash flow of the business. And also the process of accounting, it is whereby when a transaction occurs, there are source documents that needs to be kept in order for us to generate or in order for us to process the information of accounting. Then when we have the source documents, we make journals out of those source documents. And there are several kinds of source documents. We have the receipt, we have the check, we have invoice, and we have credit notes. And also, another step of accounting, it is taking those transactions and putting them into journals. And there are also other several journals which are in connection with the source documents. So after that, we take the information from the journal, we post it into the ledger accounts, and then we take the information from the ledger accounts, we post it into the trial balance, and then from the trial balance into the financial statements of the business. And there are several financial statements of the business. We have the balance sheet, or the statement of financial position, we have the statement of comprehensive income, we have the statement of changes in equity, and we also have the statement of cash flow. So the scenario, surely I'm sure you guys are eagerly waiting for the scenario in order to make you guys understand the accounting equation. Now let's say there are two individuals here, which is John and Peter. So these individuals, they see an opportunity or a market whereby they can be able to sell products or sell shoes. So in order for them to start this business, they will require their business to be financed, because there is nothing that can happen without financial support, or without having finance in order for someone to start something or to start a business. So Peter and John, they decide to put together some money in order for them to buy the stock that they need for the shoes. So Peter, he puts 15,000 rand, and John puts 5,000 rand, and that makes up 20,000 rand. So they take the money and they keep it, and then they realize that they need some more money. Then they go to the bank and borrow 50,000 rand. So altogether, that amount, it is 70,000 rand. So we split the amount. The amount that John and Peter put together, in accounting it is referred to as capital. An overall name for that amount, it is referred to as equity of the business. And the amount that they borrow from the bank, in accounting we refer to it as liability. And there are several kinds of liabilities, in which I will explain to you in another video. So what they do, Peter and John, they take the money, they buy stock, inventory, and then let's say they buy a vehicle, a second-hand vehicle, so that they can be able to deliver their stock. The vehicle costs 30,000 rand, and their stock costs 10,000 rand, and that is 40,000 rand. So the assets are 40,000 rand, and then the equity and the liability together, they constitute 70,000 rand. So they use 40,000 rand in order to buy the asset from the equity and their liability. And then another amount of money, they take it, they put it into the bank, which is the remainder. So if you were to check, assets are equal to our equity and liabilities, because we take the money, we buy assets, and we take the money, we put it in the bank, which is also an asset. So in accounting equation, it says assets are equal to equity plus liability, because any amount that comes from equity and from liabilities, it either buys an asset, or we take the money from there, and then we put it in the bank, and bank is also an asset of the business. So the accounting equation says assets are equal to equity and liabilities. So thank you guys for tuning in into my YouTube channel. Please like, share, subscribe, and click the notification button if you want to hear more of my accounting. So thank you guys.